Hey everyone, welcome to the very first DerivaDEX Roundtable discussion. I'm Aditya, one of the co-founders of DerivaDEX, which is a decentralized derivatives exchange built on Ethereum. We're super excited to be launching a portion of the exchange very soon. Before diving into that over the course of this discussion, would love to first do a quick round of intros. This might be the first time many of you are meeting me, so a little bit about me to start off with. I'm Aditya Palepu, as I mentioned. And I've been an institutional algorithmic trader at one of the leading prop shops in the world at DRW for most of my career as an algorithmic trader, trading pretty much everything under the sun. And then the past couple of years, I was working at Enigma as a blockchain engineer. And most recently this year, been focused on building out DerivaDEX to be one of the preeminent exchanges on the market. We have an excellent roster of backers and supporters, some of whom are here today. Really excited to have Haseeb of Dragonfly, Niraj of Polychain, and Dan of CMS, who have been some of the biggest champions and supporters and advocates for DerivaDEX's vision and product. I know many of you are super well known in the space already, but would love to do a quick round of intros if you guys don't mind. Any one of you could lead things off.
All right, I can start.
Yeah.
I was first on your list.
Yeah.
So I'm Haseeb. I'm a managing partner at Dragonfly Capital. We're a crypto venture fund. We've been early backers of DerivaDEX, and I've known Aditya for a few years now. I think back in
forever,
2017. Man. I think 2017 was when we first met.
Yeah.
I think it was at a blockchain conference.
Yeah.
And I've followed his journey for a long time and have been incredibly excited to see all the progress that he made in those 3 years and getting sort of all the pieces that have now become DerivaDEX. So incredibly excited to be a part of this.
Thank you. Excited to have you.
Cool. I'll take a step. So Dan, part of CMS Holdings. CMS Holdings was formed with two of the guys, Bobby Cho, formerly of Cumberland, DRW, which Aditya had mentioned he was at, and a guy named Julian, who was sort of the CTO of Circle Trade. Previously, I ran Circle's OTC and liquidity provisioning operations. We're a pretty large OTC desk through 2017 and all that mania. Very, very active on all the perpetual products sort of out of the gate. We're very early adopters of OKCoins futures and then BitMEX. So know the deriv side as it stands currently pretty well. And obviously pretty excited about the next generation of stuff that we're seeing come out, which is where DerivaDEX comes in.
Awesome. And I'm Niraj. I'm a partner at Polychain, where I focus on early stage venture, everything from exchanges and more traditional business models to more sci-fi stuff like smart contracts, which we're going to be talking a lot about today. Before Polychain, I did a lot of work in privacy, particularly on the research side, and did kind of R&D backend sort of engineering at a bunch of different startups in the Bay Area. So thanks for having me, and I'm excited to chat today.
Awesome. No, excited to have all of you on. Yeah. There's a couple other investors and angels and advisors also that will, of course, be bringing into events like this as well in the coming weeks and months. But very excited to have a complementary yet orthogonal group of people with awesome insight that are helping contribute to the vision here. So with that, I want to kick things off with a broader discussion on DeFi. And so just to set a rough agenda here. So, we're launching the full exchange towards the tail end of this year and the insurance fund more immediately. And so we'll talk about all of that as this conversation goes along. But we'd love to touch upon some of the key concepts and ideas that we see time and time again in this space. So certainly around order books and AMMs, some of the centralized versus decentralized challenges that we see, governance and token models, DeFi composability, and then also, of course, our brand new insurance model variant that we are launching. So talking about DeFi first, taking a step back, I think it's first helpful to those of you who might not be familiar with what we're doing at DerivaDEX to just outline our initial motivation. So traders are really looking to speculate and hedge with a wide array of underlying assets in a secure, censorship-resistant, and efficient manner. And it sounds very obvious that you should build a platform that is secure and usable, but it turns out in practice, we haven't really seen someone effectively accomplish both to our estimation. And so traders, this is a little overly reductive, but by and large have two options, right? You can either opt for a centralized exchange where you have good liquidity, good participation, good UX, but very weak when it comes to security of funds, very burdensome to even participate. Or on the other hand, you have decentralized exchanges that paint the opposite story, right? So you have, theoretically at least, strong security of funds, low barrier to entry, but very weak when it comes to liquidity, unforgivable UXs, very low participation. As a trader myself, this doesn't sit well with me. This is not how it should be. And so first and foremost, this is what we're set out to do, right? And it's our thesis that there is a very significant and exciting opportunity to build the right kind of platform in this space. So with that, certainly during the back half of this year, a DeFi wave, as you've seen it, has come along. Cutting through all the nonsense, though, cutting through the headless chicken mania that we've seen, would love to get your thoughts on on your DeFi thesis. So maybe Dan, would love to start with you as one of the most well-respected and accomplished traders out there. How do you see the space evolving, both as an active investor and also as a user?
Nice buttering up there. So I'll say this. I was not a skeptic, but I was definitely more skeptical of sort of the pushing of the DeFi stuff, call it 18 months ago. I think it really started to change for me when the liquidity got to a point beyond where I sort of thought it was going to be able to get. And so some of this has been bootstrapped because of all of this liquidity mining and like all this token issuance that like subsidizes some of the activity in it. But it's a little bit that got it over the hump to then get to a critical mass where now people like use it independently, right? So like there's certain activity inside DeFi that's becoming better than activity you'd be able to do in a centralized fashion. And this is ignoring like the security aspect of it, because I find most traders frankly don't really put a ton of value on like that security of funds, like being able to self-custody. I think that tends to be overplayed as an angle of like why people care about DeFi. It's really like there's price and liquidity, and then there's like security down here. I mean, like people were punching tickets on Mt. Gox like a year after they couldn't even get cash out of it, right? Like you knew like the thing was on fire and people didn't even like care. So you got to like keep that in the back of your mind about like the core group of people that you're aiming for, like using these services. So that's not to say security doesn't matter. People very much care, and there's like a lot of good reason to, but like really the liquidity, it was like the big issue. You're seeing this really definitely bearing its head in the lending protocols that are like happening on chain. And that's like really useful to get access to borrow in the longer tail of vaults. Desks like Genesis and BlockFi have like done a really good job on like the cash, the Bitcoin, the ETH, like the large assets where it's like, it's pretty easy to bilaterally sort of just go and grab slugs and like tee that stuff up. But the longer tail of assets, like it's really complicated to get 200 grand borrow in a coin 50 through 200. And like, frankly, it's just not worth anybody's time to sort of like match that stuff up. And you've also seen that work out the same way, like on the trading and execution side, where like the longer range of like assets, where it's like really hard to get a market maker to like care, let alone like pump out a two-way on it, or to even get a venue to like do enough due diligence to like list it, has just gotten cut, right? Like Uniswap was like, all right, we're just going to list everything and make a way for everybody to like provide liquidity. So that's really helped too. And it's great because you now have like liquidity day one. And it's there's a bad side of that too, right? Is that like there's no safeguard whatsoever. So you have a ton of outright scams that are getting there, but you sort of can't have one without the other, unfortunately. Like everything is going to get listed. You're going to like get the bad with the good. But like that's a really good way to like bootstrap stuff day one, have liquidity, have a market, like get it going. So I don't know, I got a little like sidetracked from your question, but like it's becoming more and more useful to us day to day. And it's starting to encroach upon being useful for like liquid assets. It's not there yet, but you started to see the brushing up of it where the Uniswap pools that they initially seeded for the liquidity mining, they were all like basically ETH dollar, ETH like sort of related price. Those became really liquid and like almost make sense over centralized order books. But the problem is it's centralized execution for Bitcoin and ETH it's almost free now. And like beyond that, like there's just margining that is sometimes hidden to the average user that like people are taking advantage of on the exchanges that they're not going to be able to compete with yet. So I see a world where it's going to eat up more and more of it, but the majors will still stick to the bigger exchanges for the time being until we get cheaper execution on some of the stuff, and access to like better margining. Like, right, the ability to trade the stuff on leverage is going to be huge. I think that like feeds into a lot of the thesis here.
Yeah, totally. That's super interesting. And you're right. There's certainly a ways to go from here as well. So hopefully we're all moving in the right direction here. Haseeb, how do you see the space moving from here, especially with respect to the globalization of crypto? I know that's of particular interest to you and Dragonfly as well.
Yeah, I mean, that's a big story for what we see as the progression of DeFi and the role that it's going to increasingly play. As obviously the big story as of this month was the indictment of BitMEX as kind of being the last bastion of the kind of sort of the death knell, I think, for the centralized exchange free for all that traditionally perpetual swaps have been. And kind of in a broader sense, if you zoom out, what I see as having been the very high level story of what's happened in DeFi is really a case of convergent evolution. In that DeFi, if you think about what was most attractive in centralized exchanges 3-4 years ago, it was almost all spot markets. Then it moved to margin trading, and then it's now moved into derivatives. If you look at the progression of DeFi really began in 2017 with Ether Delta and 0x, and this again, kind of mirroring the same evolution, it was all spot trading, very, very small volumes in the early days. Then eventually it kind of moved into being margin trading, where DerivaDEX had kind of come to the forefront. And now today, I think you could argue we're still in that margin trading phase, where arguably, of course, Uniswap is dominating volumes, but a lot of that is actually coming up from people margining by levering up through doing liquidity mining shenanigans or levering up on Compound. And so there are sort of ways to wire protocols together to create sort of synthetic margin trading. But we really don't have a robust DeFi-based on-chain perpetuals market yet, or derivatives market. And there are a lot of reasons why that's the case, but primarily the barriers are technological. And the one thing that you can always bet on is that technology only ever gets better. And those barriers to implementing the thing you want to implement just keep getting lower and lower and lower until at some point you just breeze right past them. And that I think is part of the reason why we're so excited about what DerivaDEX is working on, is that it's very clear we're hitting this technological elbow where suddenly we have layer 2s going live, we have other layer 1 scaling, we have this ETH 1.x story. You guys are doing all this interesting stuff with trusted hardware that allows you to scale and do batch settlement much more efficiently than some of the other approaches toward settling derivatives on chain. That's going to allow a lot of stuff that just previously wasn't possible to suddenly start working.
Yeah.
And I think that as an investor, what we always look for is what's that inflection point when you shift into like a new phase of evolution and you go from seafaring creatures to amphibians, right? Like, what's that first step? And it feels like we're right at that moment when we're about to see the first kind of pseudo frog step on land, and that's obviously what you guys are.
Pseudo frog over here, love it.
Exactly.
Yeah, no, that is really interesting thinking about the progression here. I mean, in like trading terminologies, you see these market cycles, as Dan knows, like these are shrinking, and to the same extent, the evolution of these platforms in trading and in centralized crypto and then now decentralized, it's also shrinking as we're seeing it. So we'll see how that evolves. Niraj, I know Polychain is one of the premier investment firms, has really led a lot of the growth here over this past decade. What are your thoughts on the future of DeFi and how it impacts the rest of crypto and the whole stack, layer 1s, layer 2s, other applications?
Yeah, loved both the answers so far. I think for us, we're really excited about new use cases, like what sort of new behaviors are enabled by DeFi and by crypto broadly, and we're just seeing a lot of really exciting stuff happening in the market. A lot of cross-chain interactions. A bunch of BTC is on Ethereum for the first time. LP shares are kind of this new primitive for people to use in their DeFi applications. Retail people are able to lend out, their spare kind of coins that they might have. I think a lot of these things are new and not super common for people to do in the regular market for kind of an average user. So I think these new use cases are really exciting. I think that there's just a lot of a bunch of young people that are really excited about the space, and so that gives me a lot of confidence and hope in what's coming forward, is that all the bright minds are are in this space right now. And so I think broadly what we've seen is like, we've seen this, massive influx. Like DeFi is kind of an industry now. There are funds based around it. People trade it actively, both retail and institutional, and that'll continue to grow. And so I think we're going to see a lot more products tailored around, getting, helping people get involved with DeFi for whatever thing, size, privacy. And so I think with DerivaDEX, like, it's enabling these kind of people, institutions or larger whales, or even regular people, to trade out of this like utopian financial system where you just have sort of one wallet address and you can go trade everywhere. And I think while the tech is still early, there's a number of really strong benefits to what's happening in DeFi. I think DerivaDEX is pushing a lot of these interesting ideas forward with, insurance mining, this kind of be able to trade anything you want in a perpetual form. And so I think that there's a lot of exciting stuff happening, and I'm really excited about what DerivaDEX is doing.
Awesome. Yeah, really good to hear. Those are all really interesting, and certainly studying user behaviors and the approach that you all take to your investment theses is something that us as, building the product is something that's super vital to understand what the users want and need as we're constructing DerivaDEX at this stage. So I guess moving on to some of the topics that we want to talk about briefly before we go over the insurance fund and mining in particular. And maybe Haseeb, we can start with you on this one. The first is around market and product structure and some of the issues that we see in current DeFi platforms. Amidst this craze and this uptick in total value locked and things of that nature, some of those metrics, it's hard for me at least to look past some of the elephants in the room when it comes to some unsolved problems. For example, like some of the challenges that AMMs have despite leading a lot of the DeFi growth till date. DerivaDEX here, and we could talk more about this, is pretty pro the open order book model. So I wanted to start off getting your thoughts on that dichotomy and also any commentary you might have on just, the current problems that exist in the DEX land right now.
Yeah, so I think it's been fairly clear that, especially with gas prices becoming as onerous as they are today, order books have really they've really flailed relative to the AMM model. So the AMMs are now completely dominant when it comes to DeFi trading. And part of the reason why AMMs work so well is that they're incredibly simple and that they're very, very gas optimized. And that allows them to basically be trading in real time without having to deal with all the complexities of an order book, which requires cancellations, which requires like trade collisions and all sorts of complicated stuff that is, generally speaking, leads to a pretty not so pleasant user experience. So the stuff in principle can all be improved upon, but it requires a number of different technological changes to how people are doing the order book models that they're working with today. In addition to that, like the other thing about the order book models, that of course a lot of what's happening in AMMs is that people are really trading assets that are relatively low volatility. So they're trading, things like stablecoin to stablecoin, or they're trading ETH to stablecoin. And at the point at which now ETH, for example, is relatively low volatility, at least compared to where it was 2-3 years ago, that allows the AMM model to like really kind of work, even though when the underlying isn't moving around too much, a really dumb constant product algorithm can do a pretty okay job. However, if you're thinking about a world where you're trading like very highly leveraged positions, then suddenly basically the rate of the sort of error rate in pricing and in execution really, really compounds when you increase the leverage rate. And that's one of the reasons why, and the other problem, of course, is liquidations are not straightforward to do on chain at this point. And so because of that, it's very difficult for people to do leverage trading in DeFi, and it's very difficult for them to price highly volatile assets, especially leveraged assets. So all this stuff requires, once you start getting into much more sensitive types of trading, you really need order books. Having kind of very simplistic AMMs doesn't really scale to these types of markets. So for that reason, I think we're seeing a lot more solutions to some of these problems start to get explored. We're seeing layer 2s, we're seeing other approaches. You guys are working with trusted hardware as a way to increase the efficiency of the underlying trading engine. DerivaDEX is working on a different approach. MCDEX is working on a different approach. So lots of people are trying new things. And I think what we're probably going to see is all this experimentation is going to show there are many different paths to creating a scalable way to trade derivatives on chain.
Awesome. Yeah, fully agree. Dan or Niraj, what do you have to say on this also?
I will say I find it funny that this is like such a lightning rod, like at this like exact moment in history. Like I don't know how and why it happened, but like the AMM
you have
people,
some awesome Twitter threads on this, by the way. I mean, you always.
Well, I mean, like, look, I obviously fall in the order book sort of like world on this because like I think you can generally recreate the AMM liquidity provisioning model on top of an order book fairly simply, right? Like one is this other thing plus something, like absent like costs and like gas and like tech related stuff. But like, in a world where like you don't have to think about that, I refuse to believe that the AMM is the dominant model over an order book that can have like, you could functionally make the order book the exact same thing as the AMM if you wanted to, right? Like you could like create that whole thing plus all the additional features of like, I don't know, like placing orders or prices and like things of that nature. So I don't know, like I'm of the opinion that that's the right way to do it. AMMs are just super useful because they're quick, they're easy, and you can get going with like almost no barrier to entry. Like you don't have to know a ton to like figure out how to use it, right? Like you click add liquidity and then you like move the slider, or you like click market buy. Like it's like the simplest UI. And what I really think people got to take from that is you need to like make that version, like that simplistic view of it, and like slap it on your like order book thing. Because I think people have like sort of forgotten that. I remember like I traded a lot on Ether Delta back in the day. And the only reason I really ever traded there is because it was assets I couldn't get liquidity on elsewhere, which I think a lot of the longer tail of Uniswap's usage has been. Obviously that's changed dramatically with like the token model and them sort of getting in like the larger assets, as I had said previously. But Ether Delta was terrible. Like it was like I remember though the orders would jump the queue. So like if you'd have like a row of bids and offers, if you clicked an offer high, it wouldn't like take all the offers to it, right? It would just take that one. So like it would just jump back. It was so weird, or at least in the beginning version of it. So like that left a lot to sort of, so I, as a professional trader, like figured this stuff out pretty quick. And I was like, all right, this is how do you use it and yada, yada. But if you were somebody coming to this day one, like it was a huge barrier. Like they just wanted to click buy or sell. Like that was all they like wanted. They like wanted the whole thing routed. They didn't want to think about it. So anyway, like that's what's super useful. Like Uniswap like just gives you that. Like you have it. Like you don't, like it's very, very simple. That being said, simple for DeFi. Like it's still complicated, especially when you got to start figuring out like, oh, what gas price do I use? How do I cancel this transaction? Like yada yada. Like that is still like just an overall issue that most crypto sort of has to like face with. But just from a markets perspective, it's like incredibly useful to sort of people that don't want to know the intricacies of like what's going on behind the scenes, more than like I have X and I want Y. Like how do I make that happen? But anyway, like I said, like at the end of the day, I think the order book model is all encompassing and like the right sort of way this stuff all goes forward. But man, is it like a polarizing thing to like get involved in that fight for some reason. And like it's very odd to me that people have drawn like lines in the sand of like what side they sit on. It's very weird to me.
That is definitely true, and you're right. I mean, sadly, some of the deficiencies of Ether Delta like still persist today, despite it being years later. So certainly some work needs to be done on that front. Niraj, how do you view this this order book AMM? Yes, as Dan said, it's a lightning rod for sure. How do you view this?
Yeah, I think I think Uniswap has a lot of strengths, which it's really strong for long tail assets. In the event where a market maker doesn't want to hold inventory or they can't hedge their inventory, Uniswap is a good model for stuff like that. And so as we've seen through DeFi Summer, like Uniswap was kind of helped enable that. These assets that aren't very liquid and no kind of professional market maker would want to hold in perpetuity, and obviously kind of can't really get a loan for it in a certain way. That kind of enabled a lot. I just don't think we've seen a really strong offering of an order book model for DEX yet. Obviously, order books are extremely strong in the centralized venues. There's still a massive delta between centralized order books and decentralized ones. So I want to give credit where credit is due. I think Uniswap has enabled a lot. But that model is not applicable to everything. So I think once technology, once better technology comes about, it's an exchange. The fees are competitive. Like fees will go down over time, and whoever can offer the best quotes is going to win the market. And so if the tech is there to enable professional market makers, of which the category is growing a lot within DeFi, I see that this open order book model being really, really strong, especially for a derivative, right, where the AMM model doesn't really scale as well, I think, in this case. So to sum it up, I think like Uniswap and kind of related AMMs have are good for long tail assets. I think have kind of this interesting LP share model. But the order book model, I think, can enable a lot. We just haven't seen it in practice yet in the DEX space at a scale and at a liquidity that makes sense.
Yeah, I everything you all said resonates perfectly with us here at DerivaDEX. I mean, as I stated at the outset, we're very favorable and pro the order book model. AMMs, have and will continue to evolve, and it'll be exciting to see how that progression takes place, and maybe in future iterations, if it makes sense, can find ways to integrate that type of structure here. But in their present construction, the way I see it is that they're fairly fragile systems, right? Like inherent to their design, largely, they don't work too well in two very important scenarios. One is large order sizes and volatile markets, and those are two hallmarks of the crypto sphere. And so it's very important for a user to understand what works and those aspects that may not work to their expectation before participating. So it can be challenging, as you guys pointed out, to properly set up a order book, but we're excited for DerivaDEX to, by way of tech, by way of partnerships, by way of strategy, to approach this in a way that robustly creates a order book experience that, safely supports liquidity providers and market takers, both of institutional and retail sizes, in a way that gives them the capital efficiency and the familiar experience that they kind of expect and would want. So that's something we're excited by. And I know we didn't talk about this, but I just wanted to highlight another interesting thing compared to DEXs. This is not the order book and AMM discussion, but something that we take really seriously here at DerivaDEX is this concept of order fairness as well, and fairness on exchanges, especially for newer participants not familiar with decentralized technologies and the role that miners play. And for example, it can be easy to overlook the miner extracted value, MEV, that these participants can cannibalize value from a system, which can really be at the detriment to traders and participants. To use, and Dan, of course, you're familiar with this, to use HFT as an analog here, high frequency trading, you see like institutions shaving off microseconds for transatlantic latencies, right? And that same type of dynamic kind of exists in the miner context as well. And so although you have, Ethereum with this 15 to 30 second block time, and you're seeing blockchains now have 1 or 2 seconds, which is much shorter, that doesn't like remove the problem. That still persists. So one of the things that we're excited here at DerivaDEX is to take that very seriously and have, off-chain trusted hardware. Haseeb, you were alluding to this earlier, off-chain trusted hardware augmented with consensus that properly and sufficiently solves for really important concepts like order fairness. And this all tied together really brings like this holistic approach that brings legitimacy to the DeFi space and the DEX space that we don't believe we've really seen necessarily, that really supports serious traders and retail traders. And I think that's very important. So that's the bet that we're taking. So with that, I wanted to move on to the next topic, which is governance and token models here. We've seen an explosion here of governance frameworks and DAOs and various flavors of token models attached to products. Would love to get a sense of what you all think is working, what perhaps is not working. Maybe Niraj, we can start with you.
Yeah, I think we've gone through some really rapid iteration in the last 6 months. I feel like we've been talking about DAOs for a really long time. And the DAO, I guess, was the biggest DAO until like the last year. And I think it's gone really good. Like it's gotten a lot better. Stuff is happening a lot faster. So I think what's working is that people are using it. Governance is actually an important part of these networks, especially in this context now of this capital formation innovation, which is paying out users for participating in a network, whether it's providing liquidity or it's trading or it's being providing cover on the insurance fund, which I know we'll talk about later. So there's this kind of new model, which I think is has a lot of analogs to potentially to mining and to staking. So I think that is teams have like reference frames for what works on the governance side. I think there still is a lot of work to do on how we actually scale these systems and like what the future looks like for governance. So this is things like, I think a big flaw of a lot of these DeFi platforms is this like kind of negative virtuous feedback cycle where, there are professionals that are just kind of mining the shit out of these projects. They can kind of hedge their exposure elsewhere, and they're not really adding anything to the protocol other than this like liquidity that'll be there for a little bit, but it'll be taken out as soon as they get the coins. And it's totally rational for them to do that, in a trading sense. But net to the community, it's not the best long-term incentive. So I'd love to see more models around, what is like a carrot or stick model look like for incentivizing people to lock coins in or kind of keep rewards for a longer time and have incentives more aligned. So overall, I think there's a lot of experimentation that is still yet to be done, but I think we're at a much better stage than we were 2 years ago, where I don't think we really understood how these systems would work and hadn't really seen governance at scale.
Yep, agreed. Dan, how do you see these governance tokens playing out?
Yeah, how it plays out. Look, I'd love to see a world where like owning a chunk of the governance like really mattered. And I think there's like there's a lot of ways you can extract value as a trader from like owning a significant chunk of the governance if the governance really matters. The issue that we see with this so far is that a lot of this is like in name only kind of stuff, right? Like either there's like a massive chunk of it that's just owned by a certain number of like groups that can like just sort of dictate the fate anyway. And then it's like, well, like what's the point if you own some chunk of the governance outside of that? So that immediately kills that plan. Or the other ones where like there's not a lot of like stickiness to actually like making it matter, right? So like you vote this proposal through, like it's like the plan, but then what ties that into actually like in reality sort of getting pushed? So like that tie in a lot, I think, like is hard still to like sort of make it. But that being said, like I think it's moving in this direction, right? So I do believe that there's a real edge in like sort of being able to like have a governance token that is strictly tied in the sense that like what gets proposed through like actually happens and then is actually distributed and like potentially like owned via like a real consensus amongst sort of the community of people that are operating with the system. I think that'll be really useful and it'll accrue value because that protocol will have value and being able to make incremental changes with it itself will like sort of add value. I mean, like I think about this in like the evil sense immediately because I'm like, well, like if you could like own enough of this thing, like how could you like wield this thing in your will to sort of like make money for you? And it's not even so much like that's like the plan or that's like how like I see it like getting unfolded, but the fact that that is a potential like revenue like P&L event means that like owning it has to have value in itself, right? So like the fact that you could squeeze it for P&L means that it has to have some value. And therefore like those decisions like are sort of relevant factors like in the market. That being said, like I don't see it yet where like anybody's tied all that stuff together. So the current crop of this stuff like a little weak still for it, but I don't know. I'm a buyer of the thesis that this will get better and like more in that direction. Like I think it's going to be a thing going forward. People love it, right? Like this is Compound did this 8 months ago now, and like it's basically been just off to the races ever since. So there's like a clear market demand for it.
Yeah. Perfect. That makes a lot of sense. Haseeb, I know you've also written a lot about liquidity mining and who ultimately are the users that are getting their hands on this token and how that may not be ideal. So would love to hear your thoughts on this.
Yeah, I mean, when it comes to liquidity mining, I think people it's another hot button topic, and I think people have very different opinions about how effective it actually is. I think as long as you understand what you're buying with liquidity mining, that I think it is very sensible. If you think that liquidity mining is going to magically win you long-term adoption and give you sticky users and give you true believers, it's just the wrong tool for that. So I think as much as it's ever been, the only way to win long-term users and to really get a stickiness is to build a great product and build a great community and get people excited and animated about what you're doing. Liquidity mining is, to my mind, very, very analogous to like having some kind of very attractive referral program or bonus program or subsidizing the upfront cost of using your protocol. Same thing as like subsidizing the upfront cost of using a startup. Like you can get people to start using your product if it's super, super cheap and cheaper than the competition. But once the prices go back up, will they stay? It really depends, right? If you don't give them an experience and a community that they love and want to be a part of, or a product that they are really enticed by, or that actually has something differentiating it from the rest of the world, then yeah, they're going to go elsewhere. They're not going to be sticky. So it gives you, what liquidity mining gives you is it gives you an opportunity.
Yeah.
It is not itself the opportunity. And I think that's one of the reasons why people get very disillusioned by it, by seeing like, oh, I did all this liquidity mining, and then the moment that it stopped or that the inflation rate cut down, everybody left. And it's like, yeah, well, that's kind of your fault for not having a reason for them to stay when the subsidy wasn't there to keep them over.
Yeah, no, that's great. And that certainly frames and aligns with a lot of the way that I certainly think about things also. I mean, the topic of governance and token models is really fascinating. Niraj, as you would know, when we were incubated at Polychain, this is like what we spent, I think, the majority of the time thinking about from the get-go at the start of this year. And your team in particular, I know Olaf has talked a lot about DAOs, and there's something that he said, as you would know, that resonated with me quite a bit in the beginning as well. And it's that DAOs are very powerful because not only do they allocate financial resources in a new way, but they allocate human capital and human resources in a very novel way that we haven't seen before. And so our DAO, what we call DerivaDEX, is, I think, particularly powerful as well because it allows users to participate in all aspects of the exchange. So this would be in controlling the fee schedules, the products that are listed, and also the roles that other stakeholders and participants play, such as who are the whitelisted set of operators, like the matching engines, the liquidation agents. So it's very empowering for every trader and user that's participating. And with respect to the token, yeah, I really couldn't agree more with what you guys said. The way I see DeFi playing out so far is that it's a lot of liquidity mining projects with maybe a product associated to it. Maybe it's almost like who cares? And for us, it's been this philosophical approach from day one and realization that liquidity mining, you guys have heard me say this before, like it doesn't just solve for a deficient product. It doesn't just magically make all of your problems go away. But instead thinking about it as, okay, you have this like strong product that has good product market fit. Now, can you construct a really interesting incentive model that gets in the hands of the right people, and also an innovative token model that binds all of the stakeholders and participants together? Now you have something that can actually keep the flywheel going. So the product itself can carry the success forward beyond it, especially when the liquidity mining inevitably runs out and dries up at some point in time. So that's something that we take seriously. We have a number of liquidity mining programs that are running concurrently that get at various stakeholders in the system in unique ways. The emission rate is not something that is super hyper jacked up like you see in most projects to date, which is very important to know. And the token ultimately also does have real meaningful utility. Right? It's a utility token on the platform that allows people to get fee reductions, participate in governance, and all sorts of other staking opportunities. So I think that that realization from the get-go when constructing the model is something that's really important. So switching gears a little bit, I know we're running a little bit short on time, so might skip over the composability section here. We'll talk about it in context of the insurance fund. Just want to mention, that composability is a big advantage, as you all would agree with in DeFi, certainly. And thinking about, how to integrate with other platforms and other protocols in this space to really grow the entire space is quite significant. And so this has helped frame our construction of the insurance fund, which I'd love to spend a couple minutes chatting about, and then would love to hear your thoughts on this approach for the viewers here today. So for those of you who might be unfamiliar with insurance funds exist and are common to centralized exchanges, and are quite necessary, certainly when it comes to leveraged exchanges. So they serve as a protection against, adverse liquidation scenarios in order to cover losses and pay out traders as well. So imagine a scenario where an exchange is very illiquid, or an order or a position gets liquidated below its bankruptcy price, so it's less than worthless. Someone has to pay for that. And instead of getting the users or the platform to pay for it prior to that, it's advisable to have an insurance fund that is sufficiently capitalized that you can start tapping into that first. Traditionally, if you see insurance funds like a BitMEX or FTX, these are some of the largest whales on the market. They're very overly capitalized, opaque processes. It's very unclear, dare I say, even possibly these funds are nefariously used. So the DerivaDEX insurance fund is a very new, radically transparent and different model. So first off, in addition to liquidation spreads being added to the fund, we're also capitalizing it by way of fees. And also users can stake directly into the fund. So first off, on the fee concept, this is very different from typical exchanges that have a typical exchange fee model. So we're taking all of that, and all of that goes towards this this insurance fund and this decentralized fund that we have in place. Insurance mining specifically, it's going to last a year. And upon launch out of the gate, users can participate by staking or depositing any number of supported collateral types. Upon launch, this is going to be USDT, USDC, and then the compound and Aave C and A token variants of those tokens that I mentioned, in addition to HUSD. Users will be able to receive DDX continuously for staking into the fund. And this DDX can be realized to their on-chain exchange wallet, so already deposited to their exchange collateral. And they can also participate in governance without actually having to then claim these DDX tokens to their own off-chain personal wallet. It's worth noting that the exchange isn't live right out of the gate. So there's actually going to be a period of time at which there's actually no liquidation risk for users participating. But when the exchange goes live and the network goes live, then as I mentioned, liquidation spreads and fees are going to be added to the insurance fund as a buffer to protect this, this class of participants, these people that are staking into the fund and bootstrapping it upon network launch. And I think, so to summarize, this is really important because, as mentioned, generally insurance funds play this sort of passive negative role for users, right? Like no one wants to be liquidated, but when there's a liquidation event, that spread just gets tossed into the fund. In DerivaDEX, the way we've shifted the paradigm here is it actually has this positive intentionality about it, where for liquidity mining, for insurance mining, users can stake directly into the fund, receive DDX tokens for doing so, and in return, this native DDX token allows them to participate in governance, ultimately giving them and the community control over things like the capitalization threshold of the insurance fund, how these funds are ultimately utilized, and this goes well beyond just covering liquidation losses, but really does promote the full exchange experience for all stakeholders and traders involved. So I know I spoke for some time here. I wanted to outline the program to our users. So in the last 4 or 5 minutes that we have here, would love to get your guys' thoughts on what we are presenting in here and how it's a very different shift and paradigm, and how users can participate in this. Maybe Niraj, if you want to start, we can just make a quick lap.
Sure. And let me know if I don't fully cover it. I'm happy to
totally
talk about anything else. Yeah, I think, it's really interesting to see this kind of system constructed, like from top to bottom. It's not just the exchange piece, it's also the insurance fund piece. Users can actually have a piece in this network, which I think is really interesting. It's never been a thing, even in centralized exchanges or centralized exchange tokens. You've never been able to have a claim on the insurance fund. So I think it's cool to see this this native way of bootstrapping the insurance fund, and seeing this like DAO structure that we talked about a couple of questions ago actually come to fruition is really exciting for me personally. I think we've talked about this like idea of the corporate structure with crypto has kind of changed a lot and has created this new set of businesses which are global first, exist only in smart contracts, and this to me is exciting because I don't think we've really seen anything in the derivative space yet that enables this at scale. And so seeing this in tandem with people trading on it, and then also doing insurance mining is really exciting to me, and I'm really looking forward to the launch of the project.
Awesome. Yeah. Haseeb, what do you think about the approach here and how it's different from what you've seen so far?
Yeah, I largely agree with Niraj in that I think the idea of giving people direct ownership over the insurance fund. I mean, one of the big complaints that you hear again and again from people who are dealing with some of these exchanges that just have massively overfunded insurance funds is like, well, what is this thing? Like, it seems like the equity in the insurance fund is potentially worth more than the entire exchange itself. And it's, I think it was obviously hard to foresee that in advance, that these insurance funds would themselves kind of take a life of their own. But it in retrospect, I think it's a brilliant model, because ultimately all of this stuff should belong to the users and to the people who are early supporters of the platform. And kind of having a more transparent and more equitable way to think about what the role of the insurance fund is, and what the role of, if you really have a decentralized protocol that becomes this a decentralized protocol for trading and doing derivatives, how should each part of that protocol be packaged together and owned by its users? Yeah. And I think what you guys are doing is super innovative, and I think there'll be a lot of excitement for it.
Awesome. Yeah. And Dan, in the last minute or two that we have here, one of the things we're also doing with the insurance fund is people's positions are tokenized. So in addition to staking and receiving the DDEX reward, your stake actually has a tokenized representation of it. As a trader, this type of dynamic, when you think about tokenized positions and leveraging that as a user, how do you see that playing out compared to what you've seen before?
So I'll be able to farm something else with my staked insurance fund token. Is that the future? I'll be able to take my Compound C token, put it from my DerivaDEX staking token to then go get another. It's very daisy chained on DeFi, but no, yeah. I think it's good.
You gotta watch out for sushi DEX though.
Is that all right? I'll keep an eye out. So look, I think that's actually a point in general though, is that like it's very cool, but I think it's also very useful that like these pieces, is particularly because they're being used as collateral in like different areas. It's like, it makes your balance sheet much more useful, which to me as like a trader is like super important. Yeah. And like anything we can do to like leverage like basically capital in multiple places like that is like just such a win. I'm gonna like take a little bit of a different tact here in the sense of like make sure that everybody's aware that the insurance fund doesn't always go up. Like I've lived through a lot of events where like the insurance fund has been like blown out, and I've taken haircuts on positions, right? And like this fundamentally gets to the issue that the insurance fund, like in this model, especially because of the governance, right, it should be set in a way where like it earns a yield and like over a long period of time. But it's gonna have fluctuations, right? Like the market's gonna move, there's gonna be liquidations, there'll be like gaps. And that whole insurance fund model, like look, there's two worlds, right? There's like OKX in like Huobi's early days, where they were just wrong on like the way of being too shy and people were taking massive haircuts. And then there's BitMEX on the other side, which is like way too far the other direction, where it's just accruing constantly. I mean, that's a function of like Bitcoin's vol going down over time and all that jazz too. But that's a problem for exchanges that exchanges ultimately shouldn't be in the business of like dealing with, right? Like you're in this model, you're like letting the market figure that out. And I think that's a much better solution. And it also makes all of like the owners of the token like care. Like you can't just be like this passive governance person if you're gonna like keep getting haircut because you're not paying attention to like what is like the real risk being set on like the liquidity parameters for the sort of insurance fund and its like expected return. So I think this is a great system to like get that model right. And I mean right in the sense that like it's not gonna be overtaxing, it probably won't be undertaxing, and it should like set like a real sort of competitive market insurance fed rate for the thing going forward. And I think all of the exchanges will never have this if they don't have some sort of feedback loop where like the exchanges obviously care if they're like losing this money, but they don't care as much as somebody who's like entire like bet and thesis is like on like getting that number sort of correctly. Like the exchanges is just, they're just passing it on, or they're eating it randomly if they like have to. So anyway, I'm super pro this. I think this is going to be like who knows how it's going to work out of the gate, but like over a long time frame, like I'm pretty bullish that this will like equilibrium as a much better sort of system for that liquidation risk.
Yeah, we're really excited to see how this plays out when it goes live. So this has been an awesome discussion. Thank you all for participating. Obviously, as I mentioned at the outset, you all have been tremendously helpful for the vision and the product. this whole year, and excited to continue this forward from here on as well. I'm sure this was exceptionally useful for all of the viewers to learn about the space, and specifically DerivaDEX, and in particular the insurance fund and mining program that we're launching very soon. So excited to have you all and the community, as we're building this to be a very community-driven exchange, be a crucial part of the DerivaDEX and DerivaDAO story from this point forward. So thank you all again.
Thank you. Thanks for having us.
Yeah.
Thanks for having me.
Thanks.
All right. Yeah. Bye.
Bye. Bye.